All right, everybody, we'll go ahead and get started. First off, thank you very much for joining us today. Alex and I will be covering how to use a 401k to start or fund a business. My name is Corey Daharsh. I'm joined today with my colleague, Alex Perny. So my name's Corey Daharsh. I've been with Advanta since 2016. I joined the business development team in March of last year fully after moving to Western North Carolina, and I work in this area to help promote and educate on self-directed investing throughout the Carolinas, Tennessee, Virginia, and the surrounding area. Alex, go ahead. I'll turn it over to you for your own description and self.
Yeah, thanks, Corey. My name's Alex Perny. I've been with Advanta here since 2012. I've kind of worn a lot of different hats, but now I'm working in education and trying to help people understand all the different aspects of things that you can do with various plans. Everything from your run-of-the-mill traditional IRA all the way up into what I would definitely call a more graduate level class of things here today that we're going to cover. Utilizing 401k plans to extract startup capital for various different uses by means of qualified participant loans, and also what are called ROBS plans, or rollover for business startups. What I would say for everyone here that's attending, make sure you ask questions. I'm assuming a lot of people here will probably have a few, I would hope, because we're certainly going to cover enough to educate, but maybe not enough to completely explain some of the things that we're going to be covering here today. So with that said, a little bit about Advanta. You've heard about who we are here. The two people presenting to you, we have a little bit over 20 years of industry experience in doing what we do here at Advanta. It's important to understand that, coming to this type of platform is that you need people that understand what they're doing on a practical level, not just a theoretical level. So we have done this kind of stuff for our clients for many years. We're very experienced in seeing the different kind of things that have worked and what hasn't, and that's kind of reflected in the amount of clients that have trusted us with doing this for them. We have currently a little bit over $2 billion worth of assets under administration, spread out over roughly 7,000 active accounts. So if you have any questions, make sure you ask them. If it has happened, we have probably seen it, and we want people to understand that we're not just kind of regurgitating this from a textbook. This is a lot of experiential learning and things that we have done with our clients and seeing clients want to do. With that said, although we are trying to give you the most accurate information here for you to make the most informed decisions possible, please don't take this necessarily as gospel. Trust but verify. Advanta IRA and our employees, we do not provide any investment advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investments. A few key takeaway points that we want people to take away from today's presentation is you can own and fund a new business by using a retirement account. And we're not just talking about a new business like many people are familiar with, let's say, checkbook control, where you're setting up a single purpose entity for an IRA or retirement plan to own for owning retirement plan assets. We're talking about a living, breathing company, something that you could actually work for, you could draw a salary from. And a lot of people would, tend to raise their hand in class and say, hey, wait, I thought you've always preached that you can't do this. It's a violation of IRS rules. Well, in most cases it is, but there are some very specific pathways to being able to do this correctly and legally, and we'll cover those. And this isn't going to be something where you can just automatically switch gears and be like, oh, great, I can start taking a salary from my single member LLC my IRA owns. These are extremely specific use case things that we're going to be covering with participant loans and ROBS plans. So just understand that before you make any decision, contact us, contact an attorney, and see what exactly you're looking to accomplish, and make sure that these pathways are a good fit. Because with some of them, namely the ROBS plan, it is one of those things that once you do it and you sign on that dotted line, it is very hard to unwind, and you have committed potentially a large amount of your retirement plan capital into a particular structure. So just keep that in mind, is that these are avenues for you to maybe get some direct personal benefit from retirement plan assets. but you need to really kind of understand the good and the bad with all of it. With 401ks, we want you to understand the concept of the participant loan, which is the ability to take up to 50 grand from your 401k plan. Now, this can be a solo 401k plan, and some of this does extend out into, let's call it, the real world too. So let's say you work for Lockheed Martin or Tesla or public supermarkets, and you have a 401k plan. Most of those plans will allow for you to take a personal loan of up to half of your vested balance or $50,000, whichever is less, from that plan to utilize personally and potentially start a business with, pay off credit card debt, a lot of things. But it's important to understand just specifically how that $50,000 participant loan works, and the terms are reasonable and the returns can be substantial for some of these things. So understanding just exactly how these different structures can work, especially when it comes to the Rob's plan of being able to create tax shelters for shareholder distributions, is quite remarkable. But again, these things are going to be extremely use case specific, and again, this hour-long presentation is certainly not going to cover everything in depth enough to where I would say you should be making a decision on this. It's definitely it's going to require a little bit more research on your end as the client. So what is an employer-sponsored plan? Glad you asked. An employer-sponsored plan is going to be a little bit different than an IRA. An IRA is going to be a specific individual retirement arrangement that is tied to you as an individual. So you are judge and jury of that retirement plan. There's no one else involved besides you personally, not your spouse, not your friends, not your parents. It is your individual retirement arrangement, is an IRA. An employer-sponsored plan, so think about the ones that have the numerical acronyms. So your 401ks, your 403bs, your 457s, your 401as. All of these types of plans are what are called employer-sponsored plans. Now, what exactly does that mean? Well, just like a race car going around the track that has a sponsor on the side of it, it's two pieces. It is you driving the retirement plan, but you have a sponsoring business attached to it, which is where the two part of the contribution comes in, where you have your deferral of compensation, and then you have a matching contribution that comes in as well. Now, this presentation is going to be focused on employer-sponsored plans. Now, these are, again, set up by an employer for the benefit of their employee, and they can come in many different shapes and sizes, but specifically to what we're going to be covering today is only going to be centric to the 401k side of this. Again, there are a lot of different types of retirement plans and employer-sponsored plans to that fact, such as SEP IRAs and simple IRA plans and all these other ones. But what we are going to be covering with regard to participant loans and Rob's plan structures are going to be exactly specific to 401k plans. And again, just for a little bit of history, these types of plans have been around, and most of these types of functionalities have been around since the mid-70s. So this isn't inherently new, or let's just call it cutting edge type of strategies and structures with these things. It may just not be very well understood by a large population of the working people in the country, just because it's not necessarily utilized a lot. Not everyone's going out and starting a business. Not everyone necessarily needs to access capital to the extent that what some of these allow. So again, it's just really important to understand the type of plans that these are effectuated to. Now, since these are 401ks, there's a few different ways that you can move money into a self-directed one for the purposes of doing this. Typically, it's done on an administrator to administrator basis via a direct rollover or transfer. It's as simple as basically just contacting us, and then we can assist you with the movement of these plan assets from your current plan, if it's already in, let's say, a 401k with an old employer, if it's in an IRA that you'd like to move into the solo 401k plan. Again, we can help you with that. The point that I'm trying to make with this slide, at least, is that the movement of these funds is in no way going to be taxable to you personally. And if done correctly with a lot of these different structures, none of this stuff should be taxable to you for the most part. Now, you certainly can create scenarios where, let's say, like with a participant loan, if you make money on the money that you borrow from the 401k plan, that's going to be personally taxable to you. But that initial tranche of 50k is not. And any movement of funds from an external retirement plan into the plan itself are not taxable as well. And in some cases, they're not even reportable. So the important thing to understand is to just give us a call. We'll help you through the process. It's as simple as just making sure that we are all in contact with the correct people and the movement effectuates relatively easily. Now, with retirement plans such as 401ks, typically it's done as a direct rollover, just so you have a little bit more information up on your screen. That's a kind of how it works. Again, I kind of covered it in the last slide, but with that said, the investment options, especially if you're taking out funds for a participant loan, are extremely varied. Now, some of the ones up on the screen are options for what we do here at Advanta for our clients to invest in with their IRAs directly, but all of these things can be an investment for you if you're trying to make it outside of your IRA. Let's say, again, using a participant loan and borrowing money to acquire stuff like this. Granted, we're going to be covering it more on the specifics of what you can do with starting and funding new businesses. But if you're at all interested, and maybe you just came here for learning some more about 401ks and different things you can do with them, all of these things are options for you to utilize directly underneath that plan as well. So it's not simply just going to be limited to the scope of maybe the business side of things. You can use these funds that you extract from a 401k plan for any of these types of investments, or do these types of investments underneath of the plan as well. With that, Corey, I'll hand it over to you for the next chunk of slides.
Thank you, Alex. So the key components of an employer plan are that it must have a sponsoring business, which is an entity that you create and have benefiting the employees of that business, mainly yourself. It can either be an LLC, a corporation, or a sole proprietorship. There are a few other entity types, but in really general case, just contact us when you're setting that up if you haven't yet, so that we can walk you through the proper process of what type of entity you might want to set up, and probably coordinate with you with your legal professional as well as to what would fit best for your needs. The employer plan must also have participants or employees. Again, in our case with solo 401k accounts, we're mainly speaking about you yourself and also your spouse, but you can have some other employees as well. Some type of plans like our solo K may not qualify for all employees, so you would want to speak with us either in the process of setting that up or before you even set it up, so that we can structure and work with you. If it is a larger plan that you're sponsoring business would need to cover, we do have referral sources for other 401k administrators that may fit those needs, but we specialize in the solo 401k specifically. And the third component of an employer plan is the contributions. So you can contribute funds as an employee or on behalf of the employees, also on behalf of the employer, and there are different limits and formulas for that contribution breakdown. I know that we've had multiple webinars in the past breaking down different ways to maximize those contribution limits. And also there's some additional types of contributions like a mega Roth contribution and some backdoor options you may have heard about but not be well familiar with. Just letting you know that we have additional resources and content out on our YouTube channel and on our website that can guide you through how to maximize your contribution on an annual basis. Putting into perspective with yesterday being tax filing deadline, you are on the very first day of 2022's contribution cycle, if you will, so that you've got a full year from hearing this webinar, if you're watching us live today or checking us out tomorrow when this goes live on our YouTube channel, to structure yourself for a maximum contribution for your 2022 calendar year. So you may be asking, what are the benefits of a solo 401k as opposed to some of those other products we've talked about, like IRAs or SEP accounts, simple accounts? The benefits of a traditional business retirement plan, like a 401k, in our case a solo K, have a higher funding limit, a higher contribution limit than your typical IRA, which is 6,000 or 7,000, depending on your age at this point in time. You can defer a large amount of your earned income and also have those employer contributions, and in addition, make after-tax non-Roth contributions to that plan, again, to get to a full maximized number, somewhere in the figure of the higher $50,000 and lower $60,000 range on an annual basis. You can roll over funds out of previous plans, like Alex mentioned a few slides back, into a solo K account. So really you can consolidate your retirement earnings and your current retirement values into a solo K plan. And then it also allows access to tax-free loans. You can escape UBIT tax for leveraged investments, which are basically any investment you'd like to make with your retirement account that utilizes financing UBIT, which is a specific tax unrelated business income tax, is not subject to solo 401k plans, or 401k plans are not subject to UBIT tax rather. So that's another positive and great advantage for this type of plan structure. The administration of these types of plans are very cost effective. With Advanta, we've got a very, very competitive cost for setting up the solo K plan. And it also allows for Roth contributions, meaning you can pay tax on a portion or the full balance in your 401k account and thus allow your investments to grow completely tax-free. So you never have to pay taxes on the earnings that you make over the course of your investments in your timeline using this account for whatever investment structures you choose. Before I jump into this next slide, I just want to reiterate that everyone can pose questions. You just have to go to the question box and go ahead and type it out. Alex and I will answer those as we are going through the webinar. If they relate to slides, we'll also have a full Q&A offering at the end. So please don't hesitate to throw any questions out there if you have any specific items you'd like us to cover in more depth, or any questions come up based on what we're presenting on at this time. So just continuing the benefits of the solo 401k, looking specifically into the Roth portion. As a business owner, just consider it that you're wearing two hats with a solo K. You're wearing your employee hat, and you're also the employer sponsoring the 401k plan. So when you're making your contributions, you can make a full contribution of $19,500, which was the 2020 contribution date, as a Roth contribution. So that is post-tax money. You are not getting a tax benefit in that calendar year for that money, but you're letting that $19,500 or whatever you're able to maximize your contribution at grow completely tax-free from that point on. Employer and employee employee contributions can be made Roth, traditional, or any combination of those two. It would be up to you to delineate exactly what is going in as Roth and what is going in as traditional, so that you can follow that and track the growth of that money moving forward. And the annual limit for each are higher than Roth IRA contributions, which I mentioned earlier is currently sitting at $6,000 or $7,000 annually if you are over age 50. So one of the two strategies that we are talking about today is the qualified participant loan. You may also hear me refer to it as a QPL. Qualified participant loan is a way for you to borrow against your 401k account to generate investment interest on the borrowing of those funds and allow yourself to utilize that cash however you desire. So as Alex alluded to earlier, if you may have an investment option that you don't want to hold directly within the retirement account, maybe you have to pay off some debts like credit card debts or other types of expenses out of pocket that you can't necessarily use your retirement account directly for, this type of plan allows you access to that money with very simple and pretty reasonable regulations. So the structure is that the plan must include language to allow for the loan, which most plans do. You'll have to just consult with your HR department or your specific benefits department to verify that your 401k plan does allow for a qualified participant loan. The maximum amount you are allowed to take is the lesser of $50,000 or 50% of the total account value, with an exception that if your value of 50% is less than $10,000, you're actually allowed to take up to the full $10,000 in that case, as long as your plans allow that exception. So again, that's something to just double check with your plan provider and make sure if your 50% figure is less than 10,000, that you are allowed to take the full 10,000 if you do have a balance above that. The standard interest rate you set. It's not set by any specific entity or outside source. It must be within 1% of the current market prime, whether +1 or -1%. But whatever that current market prime is, you set your interest rate within 1% and pay your retirement account returns on the money you're borrowing. And the final aspect that the IRS mandates in these types of plans are that you must make a minimum quarterly payment and have a maturity date 5 years from the initial loan funding. You can pay off the loan early, and there is an exception to that 5-year rule if you are able to prove that you're using this qualified participant loan as a down payment or towards the purchase of your primary residence. In the case that you are using it for your primary residence, there is no specific timetable for the repayment in full, but it must remain within a reasonable time period. So I've got 3 case studies on different ways that we can use the qualified participant loan for various purposes. The first one of which I've got here is David's scenario. He's actually making a purchase of that first primary residence like I just referenced. So David has a solo 401k account and his balance exceeds $100,000, meaning that he is allowed to take up to $50,000 from that account. He recently decided to make a purchase of his first home and he's going to use some of this money to do so. So he can borrow up to $50,000 from his plan. He has to set the interest rate within 1% of the current market. And because the loan is being paid for his primary residence, he does not need to pay it off in full within 5 years. Again, the Treasury Regulation section 1.72-1 indicates that the repayment should be paid within a reasonable time period, but it does not need to be paid within that 5-year frame. So I've got case study 2 and 3, which are similar versions of the same scenario outlined here on this slide. We've got Sarah and Sonia's qualified plans. We'll start with Sarah, who recently started a solo 401k, and her small business has built up a balance of $45,000 she's made through her contributions. She decides to set up a qualified participant loan to borrow as much as possible for her personal use. Because Sarah's balance is less than $50,000, she can only take 50% of the total amount in the plan, which is equal to $22,500 that she can borrow. Sarah did not indicate that she's using this for a primary residence purchase, so she must make quarterly payments within 1% of current market prime at the time she takes out this loan, and it must be paid in full within a 5-year time frame for the maturity of this qualified participant loan. Now, Sonia is also a self-direct startup investor. She's got a solo 401k with a current balance of $18,000. Because half of $18,000 is less than $10,000, if Sonia's plan allows for it, in this case it will, she is allowed to borrow up to 10% so that she can make that maximum qualified participant loan $10,000 minimum rather than $9,000. And the same terms would apply to Sonia as they did with Sarah. So she has within 1% of current market prime, quarterly payments, paid off within 5 years. She can use that money for whatever she'd like to. As Alex mentioned, any investments you make with that money or any earnings you make with that money while you have personal possession of it is not subject to the same tax shelter as the money and interest that you're putting back into the account per the terms of this loan. So it's something to consider if you want to take the money out for a specific investment purpose. If you can actually make that investment within the retirement account, those are all types of things you'll want to speak with either your Advanta representative about or your other legal or tax professional in those case scenarios. And at that point, I'm going to turn it back over to Alex for the Rob's plan information.
Thanks, Corey. Absolutely great information regarding utilizing participant loans. Just a few rules that you need to understand with regard to doing a few of these things before we kind of get into you have to understand that these things that we're talking about doing fall outside the scope of the rules that govern the plan assets themselves. So if you want to utilize the 401k to invest in something maybe that is prohibited, especially with the participant loans, you could do that. So while you cannot invest in something, let's say, like collectibles or life insurance with the 401k plan directly, you could use a participant loan to do that. If there was, let's say, a rare coin or a baseball card, or heck, if you like Pokemon cards or whatever it is, you could utilize a participant loan to go out and purchase that, whereas the plan itself could not. Granted, you are extracting those funds from the tax shelter, so there's that to consider, but you can also invest in things that are otherwise non-allowable underneath of the plan, and then also with people that are disqualified from the plan. So if you wanted to, let's say, put a down payment on a property that you were going to purchase from your parents, or you were going to buy a property that was going to be utilized by your children or something, let's say buy a property in a college town or something like that, you could use a participant loan to effectuate that. Now, the Rob's plan that we'll get into in a second doesn't necessarily kind of play into that same realm. But it's important to understand that if you do want some options that can help to, and I hate to ever use the word get around, but if you are up against something where you want to do something and the rules of the plan will not allow it, there might be an avenue for you to find a workable solution that is above board with IRS regulations. So, I like to make sure that we're very clear on that, is that while yes, some of these options will allow you to do stuff that is otherwise not allowable directly underneath of the plan as a direct plan asset, there are some options to do that. Now, as Corey mentioned, 401ks are generally exempted from a portion of UBIT tax, which is the unrelated debt finance income tax when you finance a new property purchase. Important thing to understand, but again, if you're using something like a ROBS plan or a participant loan, specifically with UBIT, 401k plans can be subjected to UBIT if they own shares of, let's say, an active trader business that is not structured in a way such as a C Corp, which we'll get into in a moment, can still be subjected to UBIT. So if a 401k takes out financing to acquire, let's say, something other than real estate, let's say it takes out financing to acquire an accounts receivable of a company, or to acquire rolling equipment or some other type of asset, and it uses financing, it could be subjected to unrelated business income tax. Or if it buys, let's say, a laundromat that's structured as a pass-through LLC or a partnership, it could still be subjected to unrelated business income tax. Now, the cool thing about the ROBS plan, which we'll get into in a second, is that one, by utilizing the C Corp structure, it is not going to be subjected to UBIT. And then also, depending on how you structure the actual payments from that plan, you can obviously shelter and get kind of creative with tax planning on how exactly you're showing revenues from that business entity. So with that said, why do people choose a ROBS plan, and what is a ROBS plan specifically? A ROBS plan stands for Rollover for Business Startup. Okay, stands for Rollover for Business Startup, meaning that you are utilizing a 401k plan for the startup of a new business. Now, this is a really key point to point out, is that it has to be a newly acquired or structured business, or a new business from the beginning. It can't be something that you already personally own and want an injection of capital from. Now, the reason is that people need a cost-effective and tax-effective startup source for a new business. Now, a lot of people have considerable liquidity in retirement plans. So if you have a 401k plan and you don't maybe have a whole lot of other avenues for financing, let's say there are things on your personal finance record, such as maybe bankruptcies or divorces or something that maybe would be preventing you from otherwise acquiring more traditional financing, a ROBS plan could definitely be a step in the right direction for being able to acquire a new business. Now, maybe we should step back a second. If you're looking to establish a new business, and again, remember, this has to be a newly started business, 401k funds in a typical sense, especially with an IRA, you may have been told, say, hey, you can't invest in something you're going to be personally doing, because in this business, you're going to be working for it. You're going to be drawing a salary. You're going to be paying yourself. You're going to be reimbursing for expenses. You're going to be filing a W-2 to yourself. So all of these kind of things are allowable under a ROBS plan, unlike any other type of structure that you can utilize with a retirement plan. So this is a very effective tool for that. Now, again, there's the fees for traditional financing can be very steep, and depending on how much work you need done with a ROBS plan, there could also be some initial upfront costs as well, but you do get the added benefit of the shares of the C Corp being owned by a tax shelter, which can create very interesting tax planning opportunities for being able to have your, let's say, distributions to your shareholders not be taxable to the actual shareholder, because the 401k plan holds the actual shares of the business. So the components of the actual ROBS plan. You have the sponsoring business. Now, this business must be taxed as a C Corp. Now, I know a lot of people out there would really like to say, hey, I would like to have mine taxed as an S Corp, or let's tax it as a partnership, as a pass-through. Unfortunately, you do have to elect to be taxed as a C Corp, meaning that the business itself is going to be taxed at corporate tax rates. You can't say, hey, I'm going to set up a ROBS plan and have it taxed as a pass-through, because then everything would pass through to the shareholder, which would be the 401k plan, and it would be tax exempt. So the benefit of not having to pay taxes on the distribution of the retirement plan assets for the startup capital of this comes at the trade-off of it having to be a C Corp. So that's one big thing to understand, and no, there is no way around it. This is actually codified in the Internal Revenue Code under Section 401A, that with these types of plans for startup capital for a new business has to be a C Corp. So just understand that we're always happy to get creative, but it has to be done correctly. Now, these types of things are mainly intended for the owner operated business. So the self-employed individual or that person and maybe a spousal partner, because essentially what you are creating here is a very truncated and distilled version of an ESOP. But the ESOP in this case, the employee stock purchase plan, is only being exercised by the 401k plan to become the shareholder of that C Corp. So there's a few different parts of this, and we'll get into that in a second. But the thing that you need to remember is that if you have an eligible employee, so at the time of establishing this business, and let's say it's not just you, and you're going to want to have, let's say, a bookkeeper on staff that's going to work more than 500 hours over 3 years for you, or maybe would work over 1,000 hours in a given year for you. If they had a retirement plan and you set this up and they wanted to roll over funds, you would have to treat them equally and allow their 401k plan allow their portion of the 401k plan to purchase shares of this new business. Now, obviously, that can get very frightening for people, saying, hey, my initial thought in this is to say that, hey, my 401k plan is going to own my solely owned business. Why would I necessarily want to allow other people into that? Well, it has to do with plan discrimination testing. And if you have an eligible employee and you are opening up this investment structure to the 401k plan of the business, and you have another eligible participant, you're going to have to treat them equally, and they have the potential to then purchase some of the shares, so that way your plan would then own less than 100% of the shares of the business, which could even further cause issues depending on how much money that they bring to the table. Now, the plan documents must allow for this allowance. You can't just say, hey, it's only me going to be participating with my 401k, and any other eligible participant cannot participate. That would be a violation of what are called Hce Testing Rules, which are highly compensated employee and top-heavy plan testing rules. I know that's a lot to take in, but the important point to understand is that if you establish a ROBS plan, so you have a newly formed C Corp that a newly formed 401k for that business is going to then purchase the shares for, if you're the only eligible employee of that business and the only participant in that plan, then your 401k portion is going to own 100% of the shares. If you had another eligible participant, so someone that worked over 1,000 hours a year or would work over 1,000 hours a year in the initial plan offering, then their 401k portion you would have to allow them to do so, purchase those shares. And you couldn't reclassify shares to be, let's say, a class A and a B, or a non-voting versus a voting share. You have to allow for the same qualification of shares to initially be utilized or initially be purchased. Now, that is with the participants and the employees. Then you have the new initial purchase. So the newly formed shell company, in this case, the C Corp, that is going to be utilizing the funds from the 401k plan, cannot have capital contributions to create personal equity as well. So what exactly does that mean? That means that the initial entire funding amount for this new business has to come from qualified plan money. So you can't say, hey, I'm going to have my 401k plan purchase, let's say, 70% of the shares of the company, and I'm going to inject the other 30 of personal cash to then acquire 30% of the personal equity in the company as well. You can't do that. It has to be all or nothing with this. So while, yes, it does allow you access to 401k plan assets to purchase the actual shares of the company, it doesn't allow really for any flexibility in that. The initial rollover to the new 401k is the sole source of startup capital for this. So it's either kind of all or nothing. So while, yes, it may be very attractive, but if you need $100,000 and you only have maybe $40,000 in a 401k with your IRAs combined, this may not necessarily be the best route for you. It does work very well in certain scenarios, but not in all scenarios. So just understand that there are some definite, very high barriers to entry to this, and most people kind of just get stopped on the fact that it has to be filed as a C Corp. If you want to invest in something or start a business that's going to be passing through a lot of deductions that you would like to capture personally, that's not something that's going to work here, because all of those deductions and write-offs are going to be captured on the actual corporate tax filing return of the business, and not of the ultimate shareholder, and the shareholder being the 401k. So you have two different layers of things that would be keeping you from capturing any type of write-offs or other type of expenses that you would like in this scenario. So keeping in mind that might also kind of preclude some of you from necessarily wanting to go this route, but it's important to understand that these things exist, because if you don't understand it, the IRS can certainly be, and let's just call it, a bit heavy-handed with this. So when doing a ROBS plan, there are a few different, let's just call it, portions that you really need to be cognizant of in order to do this correctly. So there has to be an initial stock offering. So when you have it, you've set up the C Corp, you've set up the 401k plan for that business entity, you have to have a stock offering document drafted by a qualified third party and a valuation of those shares. So you have to have a written stock offering or stock purchase agreement that's created for this transaction, meaning that the 401k plan is going to be listed as the purchaser of a certain given amount of shares that are being issued by this C Corp. Typically, it's going to be 100% of the shares, and most of the time people peg it at $1, but whatever the valuation is going to need to be applied to that stock purchase agreement. The purchase agreement is entered by the 401k plan and the new shell company, not the individual. So while you may be the trustee of the plan, signing as trustee of the plan to enter into and engage that stock purchase agreement, you personally have no vested interest in the share issuance by the actual C Corp. The C Corp is engaging with the 401k plan, and that's where the transaction of capital comes from. So you've rolled funds into the new 401k. The 401k has then engaged in a stock purchase agreement with that new C Corp, and then the funds from the 401k get transferred directly into the business bank account of that C Corp, and now the C Corp is funded, the 401k is now the shareholder, and then you kind of off to the races with whatever business activity that you would like to do. So that's how the mechanism works for actually going from, let's say, an IRA or old 401k into the new ROB structure. Now, a few important things to remember is that the purchase agreement must reflect the total number of outstanding shares, the shares that are being purchased, and the value. Now, this is not something that, again, you can just take at face value. You need to have qualifying individuals do these types of documentation for it. Namely, most of the time, you're going to want to engage what's called an ERISA attorney. That's ERISA, standing for the Employment Retirement Income Securities Act. It's the act that we kind of actually mentioned it earlier in this. It is the chunk of legislation passed back in the 70s that created retirement plans as we kind of know and look at them today in the US. So you need to have some different people involved. You need to have the plan document provider that can provide the plan documentation for the 401k, the valuator for the shares, and then also someone to draw up that stock purchase agreement and file the C Corp registration. Now, with the 401k plan, so again, let's just kind of recap that. You start from the point of having an old 401k. You want to start a new business. From there, you establish the new 401k plan. You have that is going to be attached to the newly formed C Corp. That 401k plan and that C Corp will then enter into a stock purchase agreement that will also accompany a valuation of the issued shares that are going to be acquired by the 401k. You roll over funds from your old 401k into the new plan established for this new startup C Corp, and then the funds from that 401k are deposited to the C Corp's bank account. The 401k receives the certificate of shares, and then the business is funded and you can move forward. Now, that's a lot to kind of take in, and I'm not going to try to downplay that. But also further on from that, there's additional plan reporting requirements for the 401k that need to be addressed as well. So unlike with a typical newly started 401k or solo 401k, if you have less than $250,000 of plan assets, you are under no obligation to file what's called Department of Labor Form 5500 EZ. Now, 401k plans, think about it. Think about the 5500 EZ as the tax return for a 401k. That's kind of the best way I can describe anything analogous to that. You're not filing taxes, but it's just the plan reporting that you have to do. It is not required unless a plan is over plan assets of over 250,000. However, if you are doing a ROBS plan, you are automatically required to disclose that the funding of the 401k came from a rollover for business startup qualifying event under section 401A of the Internal Revenue Code, and then continually report 5500 EZ every single year while the plan is in effect. So not only do you have kind of a large amount of paperwork and consideration going into the front end of using a ROBS plan, you also have automatically elected to then having to do 5500 EZ reporting. So 5500 EZ is not as scary as it sounds. It's relatively easy if you Google search it. Most people can do it themselves, but it's an important thing to remember because you could potentially disqualify your plan if you don't file that in the first year of funding and every subsequent year, and then cause yourself a whole host of headaches if it comes down to a disqualified 401k plan then no longer being in existence, but still being the shareholder of an active trader business. So I think people can kind of clearly see how many problems can be caused later on down the road by not properly taking care of all this. Now, again, this is a lot, and I'm not trying to pretend that it's kind of an easy route forward, but it is a very specific use case for you to be able to personally benefit from 401k funds for the startup of a new business. This is the way to do it. There really isn't any type of other mechanism for doing this that is any less complex or any less straightforward. But we're here to help, and if this is something that you're interested in doing, we can walk you through the steps to help you with getting that done. Now, again, remember, you do have to have a valuation letter, and this has to be provided by a third party. Part of the qualification for this is that you can't self-certify the valuation of the company as the trustee or the sole employee. You have to have a third party, qualified independent third party, so CPA, attorney, that actually will issue the valuation, and a third party in good faith drafting up the purchase and sale agreement for that. Now, another thing to consider with a ROBS plan is that if you ever wanted to issue new equity in the future, there are restrictions on doing that. Meaning if you wanted to raise more capital, you may not necessarily be able to raise capital for that C Corp that you've set up by issuing shares or selling shares outright. You might have to do it with a debt instrument, something like a debenture, and maybe not even a convertible debt instrument, because there are issues in that are going to be written into the plan document that is specific to utilizing a ROBS plan, rollover for business startup, on the availability of future capital being injected from a third party. So again, to summate, you have the ability to utilize 401k plans to start up a new business. You have to be considerate of current employees if it's only just you. Also the fact that you are electing to be taxed as a C Corp, and then the valuation, the stock purchase agreement, and the relationship between all of these different things. It is, again, by no means the simplest thing in the world, but it is a clear and legal path forward for you if you want to utilize plan assets to invest in a new startup company, and you need, let's just say, more than $50,000 in order to be able to do that, because that's the kind of limiting factor for your participant loan. So what are some of the additional problems that arise, and what are some of the issues for this? ROBS plans can be seen as an audit trigger for new businesses. Now, I say this with a very big grain of salt. What is an audit trigger? It is always kind of hard to say, but it is relatively understood, and at least from available literature, that doing a ROBS plan can open you up for audits, because these things do tend to fail a lot. It's just kind of the nature of the beast when it comes to startup businesses, that you are entering into something that has a high degree of likelihood of failure. Startup businesses fail more often than they succeed, which is kind of a sad reality, but it is something that you need to consider, is that you are going to want to have some of the people that you engage from the beginning, such as an accountant or valuator that understands maybe the audit process for someone doing a ROBS plan. So understand that this, while maybe isn't as bad as claiming 23 dependents as a single filer on a personal tax return, it definitely might open you up to having some additional scrutiny placed on your tax filing, whether that's personal or business, because remember, it is a C Corp, so you do have to file a business return for it. You are placing substantial risk on your individual personal retirement plan finances, because if you utilize the entirety of your 401k plan in order to fund this new business and the business fails, there's really not much you can do to recoup that. It is going to simply be a loss to the 401k plan, and you might have just wiped out your entirety of your retirement savings with the new business startup. So again, I encourage people to think long and hard about this and also get some very good advice, because paying for a financial or business advisor's advice and a couple $1,000 worth of it could be significantly cheaper than losing hundreds of thousands of dollars on a failed new business startup. Not to say that your business might fail, but there's the probability that it might. And if you're using this structure, it's something definitely to consider. So again, there's little tax write-off incentive for that. There's many steps that must be followed, or serious issues can arise in the future. And if additional capital is needed, the ability to issue new corporate shares can be limited. So that's really what I have to say about Rob's plans. Maybe the 20, 25 minutes that I've had to speak on it really kind of just only scratches the surface of it. I am more than happy to answer any questions that people have. I don't see any typed into the chat. But if you do want to reach back out to us, feel free to give me a shout. I'm always happy to kind of review this stuff. I tend to talk to most of the people that call in about it. So with that said, I'll hand it back over to Corey to talk a little bit about what we have going on in the future and coming up.
Yeah, thank you very much, Alex. Extremely insightful information. So thank you so much for your time and dedication in putting those slides together and going over a pretty complex topic in the realm of self-directed investing, where a lot of things, once you get the account set up, is relatively easy and the onus is on the account holder. These types of plans definitely have a lot more nuances, and I'm glad you were able to cover it.
For sure.
So before I jump into our Learning Center and education, I do want to cover a few of the questions we do have in the chat box. They didn't necessarily relate directly to the Rob's plan, but let me start from the first one I see unanswered. Please define disqualified person and whether an LLC controlled/managed by the plan owner would also be disqualified. That is a great question. In most case scenarios, actually all case scenarios, an LLC that is owned 50% or more by an individual that is considered disqualified, meaning yourself, your spouse, your lineal descendants or ascendants, is a disqualified entity for your retirement account to transact with. So if you're thinking that you could utilize your retirement account and do a deal with an LLC that you own or a disqualified person owns, that is an extension of disqualified person rules. The next question, is it necessary to set up the business as a C Corp? The answer is yes. I think Alex covered that pretty thoroughly on one of the specific slides. The next question I see here, per one of your Advanta IRA blogs, Biden wants to force investors in private placements and single member LLCs to remove them within 2 years from their IRA accounts. Will this happen eventually? And then in subquotes, yes, I know it failed this time, which is referring to the Build Back Better bill and the modifications that took place towards October, November or so of that bill. What options can we switch to and still not pay taxes on profits? I have a Roth IRA. Thank you. As of right now, I don't know that we have any pending legislation that is in the same attack or in the same vein as we were when that version of the Build Back Better bill was out there. This is something that obviously has a significant impact on our industry, so we are always at the forefront of learning on this information and finding when those things come up. We try to notify our audience as efficiently as possible to the effect of, will this ever happen in the future? I do not know. I can't really speak to that until we see some sort of potential legislation coming up. And Alex, do you have any opinion as what options that an individual worried about this may be able to switch to as far as a plan type?
Yeah, I mean, I equate it to being afraid that anything's going to happen. And specific to your question, I think it's always important to understand, and focus efforts on bad legislation to exactly where they come from. We try to remain very apolitical here at Advanta, but it's not necessarily entirely accurate to say that it's Biden. It's actually Senator Wyden out of, I believe, Oregon. on the West Coast that was actually the sponsor of that portion of the bill. This actually isn't the first time that he's actually tried to push through that type of legislation with regard to basically disqualifying private partnerships and those types of entity investments from IRAs. It's been defeated both times. Once was a chunk of legislation called the RISE Act, which was handily defeated under the Republican-controlled House and Senate under the Trump administration. And even though we had Republican or democratically controlled three branches of government now with the Biden administration in power, we still had that type of legislation removed. So while again, I just like to always make sure that we're focusing our efforts on where this stuff comes out of. It is a single legislator that kind of promoted it, and we've been able to kind of come together, and a lot of some good has come out of government with the defeat of that. To the point of if this is going to what people can do about it. Unfortunately, there's not much you can do. If the government says that you have to do something, then, what can you do if there's already structures in place? I would imagine that, there would either be some type of grandfather clause for people already invested in highly illiquid assets, such as long run play, limited partnerships, and things of that nature, especially if you're invested in things like commercial real estate, which have, basically zero liquidity until there is liquidity, or other types of highly illiquid assets. It would be a humongous financial burden for people to have to distribute those types of plan assets or try to liquidate them. So, it's hard to say what options would be out there. It's just kind of hoping that with continual defeats under several different administrative leanings, whether it's Democrat or Republican, for this specific chunk of legislation, that hopefully other senators that are co-sponsoring bills like this will kind of see the writing on the wall, and they'll stop trying to do it. Because again, this is the second time it's been defeated with a handily more stacked benefit to being passed, but it still wasn't. So that's kind of how I would answer that. I was very involved in our efforts for educating people on what that was, but essentially that was the Build Back Better, and it was removed back in about October of last year. And nothing with that or the additional amendments to the Secure Act have given any inclination that that kind of stuff is on the immediate radar for any type of legislation coming up.
All right. Thank you very much, Alex. And the final question, unless we get any further, is there a way to transfer a piece of real estate held in an IRA to some other post-tax entity? If so, how? My understanding is that once a property is held in a retirement account, as far as transferring it out of the retirement product, that would involve a quitclaim deed and typically a distribution request where you are claiming the value of that property, whatever its value is assessed by a certified appraiser, with a distribution request. Now, if you roll that into another post-tax asset, that may be something to avoid or circumvent the taxes on. But to my understanding, the only way to really move a piece of real estate out of a retirement account is to get a certified appraisal done within 60 days of the date of pulling it out of the IRA, and then you could move it into whatever other entity or asset you see fitting. Alex, do you have any further input to that effect or to that question?
That's kind of on it. I would just be curious to know what other type of post-tax account you're talking about, really, would be my question. If you just wanted to transfer it between IRAs, that's easy enough. So long as it's the same tax qualification, there's just a quick claim deed and there's no valuation needed. If you wanted to take it outside of the tax shelter, which I don't think you do by the kind of the structure of that question, then yeah, what Corey said would absolutely hold true of needing to get an appraisal and everything. So without knowing a little bit of additional context, kind of hard to answer. I don't really have anything else. What Corey said is accurate. So yeah, that's kind of what I got to say on that.
All right. That individual said to an LLC. So really the question there is that LLC that you're referring to held within another retirement product of the same tax shelter as Alex just referenced, or is that a personally held LLC? And in that effect, it really, that is the answer, is if that LLC is a personally held LLC. So personally held LLC in most cases is not going to be a post-tax entity. So taking that out of the retirement account would be subject to the taxable distribution nature. Correct, Alex?
Bingo.
Okay. All right. Well, just to touch on what else we have going on in Advanta, we do try to put a very high emphasis on the education that we put out. We have lots of events going on. Typically, we try to do two of these types of webinars per week, as well as our bi-weekly Pitch, Promote, Prosper event. All of the webinars that we do, as you're watching now, will be posted to our YouTube channel. We've got tons of videos, a lot of expert guest speakers outside of our Advanta team. We also have a podcast that Alex heads up and is the host of. And we have a blog if you wanted to check out industry news, like the individual that asked about the legislation. You can find information about things like that on our blog. Just to go through quickly, for the upcoming events, we've got Pitch, Promote, Prosper this Friday. I'll explain that a little bit more thoroughly on the next slide. On Tuesday of next week, I will be presenting the basics of syndication investing with expert guest Bill Zahler and Richard Coyne from Park Capital Partners, LLC. They are a syndicator group in the Southeast, specifically located out of Asheville, and they're going to cover the basics of how to syndicate, what you want to look for as an investor, what the actual syndicator or plan sponsor looks for when they're finding different deals. So that's going to be a great one coming up next Tuesday, 12 noon. Thursday, I believe Alex is actually going to be working on a webinar on Thursday the 28th on assisted living investing with guest speaker Vinny Chopra. Alex, do you have anything to say about that webinar coming up next Thursday?
Yeah, it's going to be a great one. Vinny Chopra, also known as Vinny Smiles, will be on with us talking about the new and I shouldn't say new and exciting, but the very interesting aspect of investing in assisted living facilities, whether that is long-term care, memory assisted care, all sorts of different things. He has a lot of great stuff going on as a national speaker and an investor nationwide and worldwide in these asset classes. So yeah, no, we're really big on education. We take it very seriously on the fact that the best investor is an educated investor. So let us know how we can help you. All of our education is always free. It's one thing we like to hammer home is that we try to have open access to any and everything we do. So all of our education is free. So if you want to take advantage of that, it's just going on our website, registering, and we'll send it out to you.
All right, perfect. Thank you, Alex. Just before we conclude completely, it is very easy to set up an account with Advanta IRA. You could contact Alex or myself. It takes about 15 minutes to complete our account application. We pair each client with a dedicated client account manager. That will not be Alex or myself. That will be a dedicated client account manager. That is your one point of contact with Advanta when you have any questions, concerns, looking to talk through a structure of an investment. I actually served in that role for about 5 years before switching over last year. So it's something that our team has developed so that you get dedicated assistance with someone that knows you and gets to know what your strategies and plans are. And you're not just being bounced around a call center when you reach out to us for any new questions, new assistance, or new help. It's easy to fund your account, as Alex covered in the intro. You can typically fund your account with a non-reportable, non-taxable event. The only time you would really have a taxable scenario in funding your account is if you're choosing to go from a tax-deferred account to a post-tax account, letting your funds grow completely tax-free from that point moving forward. And once you have the account open, once you have the account funded, you can start investing however you see fit. Again, that is the beauty of self-directed investing. You, the self, choose what you would like to invest into. The final piece of information I have before I redisplay our beautiful faces and contact information are our Pitch, Promote, and Prosper event. This is something that we do every other Friday. It falls this week on the 22nd, where you as the investor or any investment providers get together on a Zoom call with us. And you are allowed to give your elevator pitch as to what you've got going on, what you're looking for, what you have to invest, and basically network from there. Everyone will exchange contact information, everyone will exchange questions, and different philosophies and different topics get discussed towards the end of the session. But everyone has basically a minute to a minute and a half to say who they are, where they're from, what they're looking for, what they have to offer. And from there, we allow you to network and so forth from that point. Again, as we said earlier, and Alex showed the specific disclaimer, we do not provide any tax, legal, or financial advice. So you won't be getting that in this session. You'll just be hearing from other investors, and it's up to you to do your due diligence and decide from there if you'd like to continue any further with anything you may hear about or want to invest into. And I'll just give it one quick minute with our contact information here at the end. Again, you can feel free to contact Alex or myself with any questions. I think someone asked if they could call me in about 5 minutes. Yes, I will be happy to take your call. So feel free to reach out. The number there is my direct line, 727-223-3046. Alex's direct line, 727-754-9954. If you're looking to meet with either of us in person, Alex is located in the Western Central Florida area, Tampa Bay area, and I am located in Asheville, North Carolina, Western North Carolina. I also do travel relatively often to Charlotte, Greenville, South Carolina, Johnson City, Tennessee. A few of those different cities in my surrounding area I get out to. So if you're in any of those areas and would like to connect in person, feel free to reach out to either of us. Alex, any
Indeed.
final words? Go ahead, I'm sorry.
No, that's it. We'll let everyone get back to their day because we're just right out of time for everything. So hope everyone has a great day. And if you want to circle back on this, let Corey or myself know. Other than that, have a great day.